Good morning and good afternoon, and welcome to the March 2023 DTN WASDE webinar. My name is Andy Miller with DTN, and I'll be your moderator today. And with me, as always, is Todd Hultman, lead market analyst for DTN. Just a couple of housekeeping items. During this event, all participants will be in listen-only mode. We do encourage you to ask questions. To do this, click on the chat section on the bottom right of your screen. It'll open a Q&A panel, and then you can type your question and click send. We do encourage you to ask questions at any time during the presentation. We'll save them up for the end. We'll have a full Q&A session with Todd. Also, this event is being recorded and rebroadcast, and we'll be adding this to the DTN website within the next 48 hours. So those are the basics. Todd, I think I will turn it over to you.
Very good. Thanks, Andy. Good afternoon, everybody. Thanks for joining us as we take a look at the March WASDE report here on a Wednesday. I've titled this Slower Corn Demand Addressed in March. I think that was the big expectation coming into this report. We've seen some a pretty disappointing export pace all through the first part of this season for corn, and it seemed obvious that USDA would address that some more here in this report, and they did. So let's go ahead and dig in and look at the figures that we get today. So starting with corn, we'll take a look at the U.S. balance sheet from USDA. The far right column are the newest estimates out today for the current 2022 to 23 season. And as we look in that lower right corner where the red box is, we see that USDA did increase the ending stocks estimate from 1.27 billion bushels up to 1.34 billion bushels. And the entire change was a result of a reduction in the export estimate, a 75 million bushel reduction down to 1.85 billion bushels. So that came in maybe a little higher than expected. I think most of us were expecting at least 50, but certainly knew that more was possible here on the table given the poor pace of export sales we've seen so far in the season. So that was the one and only change to the U.S. balance sheet for corn today. The average farm price was reduced a dime from $6.70 a bushel down to $6.60 a bushel. But I'll give you our DTN view of today's change in the price here in just a minute. Let's go ahead and take a look at the world estimates for corn. Starting with the red box in the upper right corner, we see that the USDA's estimate of world ending stocks was increased slightly from 295.3 up to 296.5 million metric tons. I also like to look at the ending corn stocks excluding China, and in that event we also got an increase from just under 88 million metric tons up to 89.1 million metric tons. So what made the changes? Well, the number one thing we were all wondering about was how low would USDA go on Argentina's crop estimate for this year. Argentina's obviously been suffering drought throughout the entire season. Their corn crop was last rated at 6% good to excellent, so it's been widely known that Argentina has a poor crop, and USDA's current estimate of 47 million metric tons has been much higher than local estimates. Well, USDA dropped that down to 40 million metric tons, so there's a 7 million metric ton drop. There's still some room for that to come lower, but USDA's drop was a bigger drop than was expected that would happen today. So we are getting closer to those local estimate numbers that have come out recently. In the case of Brazil, no change in that crop estimate, 125 million metric tons. We've been on that number for quite some time now. That crop is just getting planted. I believe we're roughly 70% planted on that crop. So it won't be long before that'll be taking off. I want to note, we had a big cut in Argentina's crop. Why did the ending stocks estimate go up? Well, one of the factors here was USDA's estimate of world demand. So if you see the blue box in the third column from the right, domestic total, that's domestic total use. And you see that the number for March actually came down roughly 5.5 million metric tons there. So at the same time, USDA estimated a smaller crop from Argentina. They're also shrinking the estimate of world corn demand. And the last thing I want to point your attention to is in the second column from the right, and that's on the line for Ukraine. Even though Ukraine's corn production estimate stayed the same at 27 million metric tons, USDA once again increased the export estimate of corn out of Ukraine from 22.5 up to 23.5 million metric tons. It continues to be very impressive that Ukraine has been able to export as much corn as they have this season, given the war conditions. Judging by today's total from the USDA, Ukraine's corn exports are only down roughly 140 million bushels from a year ago. So again, that's quite extraordinary, quite a testament to the Ukrainian people and the cooperation that Ukraine's been getting, moving corn out the western end of the country, as well as through the Black Sea with the Black Sea Grain Initiative. And by the way, even though there's some question as to whether that grain initiative will be extended in March, it seems likely that it will do so, as Russia benefits from it just as much as Ukraine does. So that will likely continue, and it's been, I think it's been quite impressive once again to say how well Ukraine's been able to move their corn this year. The world corn picture doesn't look too much different. The ending corn stocks, excluding China, however, did go up for the world total. The USDA estimate now is 3.51 billion bushels. That's the second lowest total in 10 years. So it's relatively in the same spot, but just slightly higher this time around. Again, we're dealing with world supplies that are available, but certainly down from peaks of the past 6 years. Corn's fundamental estimate. I used to have a different fundamental model on, and I've revised it because, quite frankly, the inflationary period we're in really distorted things, and it made it very difficult. Even though we tried to index the old prices for inflation, it distorted things. So I revised the fundamental model and included the cost of production. So what we're looking here as is when we have a certain supply situation, in today's new ending stocks to use ratio, by the way, is 9.7%. It's up from 9.1% last month. So what we're looking for is, judging from previous times in history, we've had something close to a 9.7% ending stocks ratio. What would we expect cash prices to be? And I charted that here in relation to the cost of production, because that's another factor that's moved a lot the past 2 years. And in that fundamental model, the price average comes out to be $5.80 a bushel. Now, obviously, I should mention there's two things here. Obviously, we're lower than USDA's estimate of $6.60 a bushel. But keep in mind, USDA's estimate is an average farm price for the entire season, and we're already through 6 months. So their average estimate price is already heavily weighted into the prices that corn is already traded at. This is simply a snapshot in time that says when 9.7% ending stocks are being estimated, this is the target price that the market usually trades at, and it's a cash average price based on our DTN National Corn Index. So $5.80 is a bushel is the target here. Last night's corn index at DTN closed at 640, so there's some discrepancy here, and so we would expect a bit of a downward bearish pressure on the corn price, and we're certainly seeing that not just today, but recently. The national corn basis, before earlier this year, we were taking the national corn index based off the March contract. Well, that's changed now. The basis is being referred off of the May contract. And so in this new situation, we're no longer at the strongest level in 20 years anymore. We're actually the second strongest level. It's still extraordinarily high, and it still suggests that we have very strong domestic demand for corn, and that's one of the things helping corn still stay above $6 the way it is. The strongest basis the past 20 years is it's a slightly purple line you see trading above there. That was actually for 2013, so that's the months following the 2012 drought. that we're comparing to at this time. So again, this is quite a strong basis situation, quite a strong demand situation, especially for our domestic corn, even though our exports have been quite the dismal failure so far this year. Here's the path of the exports that we have so far, and there's a few things I want to point out from this chart. This data is as of February 23rd, which is the most recent weekly report. It shows 592 million bushels of corn shipped at this time. The green shaded area is last year's pace, so you can see we're well below that. And the black line is the 4-year average, and we're well below that. We're actually down 42% from a year ago. The other thing I wanted to point out is, especially if you put your eyes on the black line, you'll notice that in early February, there tends to be a shift in direction. We start to see an increase of corn export activity at that time. And usually it's that soybeans get preference early in the season, and then when soybean shipments start to die down, then corn shipments start to pick up. Well, if you notice on our red line, which is the current season, we're not seeing that shift yet. And number one, we don't really have the sales to move. And so it's obviously a very difficult situation here. And it's largely because we're getting so much more competition from Brazil this year. They did have a record crop last summer, and that continues to weigh on our corn market. Now, just recently, we saw a little bit more corn activity happening, and we've had some sales to China, presumably, or unknown, whichever one you prefer there. And there may be more potential for that in the months ahead, but we have a rather narrow window with Brazil's next corn crop just getting planted at the moment. So we have until roughly June before we'll start losing our opportunity here. So obviously, off to a tough start, and it's hard to disagree with USDA's move to bring down the export estimate in today's report. The ethanol margin continues to stay somewhat depressed this winter. The blue line that we see on here is the processing value of what's created when they process corn at the ethanol plant and they get ethanol and distiller grains and corn oil. Last fall, that value was in the $9 to $9.50 region. Today, it's at, well, $8.32 in the most recent report. So the encouragement at ethanol plants still remains a bit subdued. The good news is ethanol production is still holding up 1% from a year ago. The estimate was not changed in today's report. The USDA is still estimating 5.25 billion bushels of ethanol each year, so that's good news. And of course, the recent drop in the corn price does help widen the margin a bit. So it does reduce the cost at the ethanol plants, and at some point that might help things pick up a bit here. But one of the bearish factors, gasoline demand since September this year has been down 5% from a year ago. So slower gasoline demand certainly adds to the bearish weight on demand for ethanol. Lastly, the speculative positions in corn are a bit of a bearish concern right now. You know, they weren't much of a problem most of the year as prices traded sideways, but now that prices have clearly broken lower in the past couple weeks, we show speculators net long 282,000 contracts. This says as of February 27th, but I don't think that's right. I think I misstated that. It might be February 7th, sorry. And the confusion here, of course, is that, as you probably know, there's been technical difficulties at the CFTC, and the reports have been delayed. So I believe that date is as of February 7th. My mistake, sorry about that. But the point being that we have a sizable amount of non-commercials or speculators long in the corn market, and now that prices are under pressure, it's going to add weight and concern to the speculative side of the market to liquidate those prices down. So that adds further selling pressure here. All right, let's take a look at the soybean numbers for today. And there was actually a bit of a bullish surprise in soybeans. We look at the red square in the lower right corner, we see that the ending stocks for soybeans were reduced from 225 to 210 million bushels today. That was less than expected, not by a big amount, granted, but less than expected. The average farm price stays unchanged at $14.30. We'll talk about that in just a minute. But the two culprits of demand were basically the only two sources of demand for soybeans, and that is, number one, there was a slight reduction in the crush demand level from 2.23 billion bushels down to 2.22 billion bushels. And that's fine. The crush pace is down roughly 1% from a year ago, and there is room to make that adjustment. That's understandable. But the more bullish side of today's adjustment came in the export total. And instead of 1.99 billion bushels, USDA is now estimating 2.015 billion bushels. So that was a 25 million bushel increase in the export estimate. If you were with us in previous WASDE sessions, I mentioned that I think USDA went too low when they went down to 1.99 billion bushels, and today's report kind of confirms that thought. So we've had a very strong export sales pace so far this year, as we'll take a look at in just a minute. On the world numbers for soybeans, in the upper right corner, you see the ending stocks estimate today was reduced modestly from 102 million metric tons down to 100 million metric tons. That was just what analysts were expecting in Dow Jones pre-report survey. The little blue square to the left there, again, shows that world demand was a factor in this move today. USDA's estimate of world soybean demand actually was reduced 5 million metric tons in today's report. And it wasn't China. We can't blame China for this one. Or excuse me, we can blame China for 2 million metric tons of it. If we go straight down that third column from the right, we see that China's demand estimate was reduced from 115.3 to 113.3. Frankly, I'm very skeptical of the reduction for China in today's report. And I know there's been a lot of negative economic headlines about China and a slowing economy and all that sort of thing. But looking at China's prices on the Dalian exchange and looking at the level of buying activity that they've given us at the U.S. this year, China's purchases of U.S. soybeans are up 15% from a year ago. And so I just don't see any sign of slowdown when it comes to soybean demand. So I'm not sure what USDA is thinking here, but they reduced their demand estimate partly for China. Now, getting to the production estimates, which everybody was wondering again about what they would do with Argentina soybeans. Instead of a 41 million metric ton crop, USDA reduced its estimate down to 33 million metric tons. So that was quite a drop, actually a lower drop than the analysts in Dow Jones survey were expecting. And if true, that would actually be the lowest soybean crop in Argentina in 14 years. So that is quite a significant hit from drought. And from everything we can tell, that's a legitimate estimate. So that takes a little bit of the shine off of Brazil's record crop this year, which is still estimated at 153 million metric tons. And by the way, Paraguay's estimate standing even or unchanged with a month ago at 10 million metric tons. So they're having a better crop than they did a year ago. But overall, the world ending stocks or world soybean stocks that USDA estimates here coming down 2 metric tons or 2 million metric tons, which is just right in line with expectations. So no big shakeup here in these numbers. The fundamental model for soybeans, same thing for corn. We're looking for prices in relation to their production costs. And this is where things get interesting. Because we're at the very tight end of ending stocks, to go from last month, we had an ending stocks to use ratio of 5.2%. And even though it was just a slight 25 or 15 million bushel reduction, it drops us down to 4.8%. But because we're out at the tight end of the history of supplies that we've had, we're at a much more elastic point on the curve here. So the bottom line being that it doesn't take much of a drop in ending stocks to boost the price estimate for soybeans. That current estimate, based on this historical model, which goes back 24 years of data, suggests a cash soybean price of $15.78. Our current index last night, nationally speaking, was $14.81. So the model actually suggests that soybeans traditionally have room to trade $1 higher. This is old crop soybeans, by the way, and it would peg it at roughly 32% above production cost. So this continues to be a very bullish scenario for soybeans, and especially as we're at the tighter end of the history of soybean supplies. By the way, it's still the lowest ending stocks estimate in 7 years for soybeans. Soybean exports, again, as of February 23, soybean exports totaled 1.53 billion bushels. They're actually a little higher than the green shaded area. They're up 2% from a year ago. And of course, they're up from the 4-year average. So you can see most of the strong increase in that red line this year has been largely due to the increased purchases from China. So it's been a very good year for us. And in fact, sales have been so strong that even right now, with 6 months to go, our sales on the books are within 134 million bushels of USDA's export estimate. And if someone's thinking, well, what if China cancels their sales? Well, China doesn't have many sales to cancel. I think last I looked, they have maybe 70 or 80 million bushels of sales on the books that have not yet shipped. So there's really not much vulnerability here to how strong this is, and it certainly merited at least a 25 million bushel increase in today's report. So I'm glad to see USDA did recognize the very bullish situation that's going on here. The soybean basis, again, we're comparing now to the May contract instead of the March. The cash basis as of last night was 34 cents below the May contract. It's eased a little bit over the past month, but it's still the strongest basis on record since 2013. As you can tell, comparing to the corn chart, it doesn't sit above all the others the way the corn basis does, but it's still strong historically in that we haven't seen this strong of a basis since 2013. And again, 2013 were the months that followed the 2012 drought. So that's quite a bullish time in history we're comparing to right now. And of course, with export sales strong and crush incentives very profitable, it makes sense that we have a very strong basis right now. So they all, I think all these clues support each other, that we have a very strong demand market for our old crop soybeans. As far as the crush goes, we saw a little hiccup in prices recently based on the May futures. The May crush premium right now is $3.11. But as I've mentioned before, if we looked at this crush computation anytime before 2002, we would only see premiums of about $1.50 to maybe $2 at best. So we're still up here in historically very profitable activity. And I think the only reason that we don't see more crush activity happening in the country is, quite frankly, I suspect that the getting and obtaining soybean supplies in some areas could be quite tight. And so we don't want to be in any rush to push up those prices, but it'll be interesting to see what happens to this formula as the summer goes on. But if you look at the blue line, that's the value of the crush. That's the value of the meal and the oil that comes from crushing 1 bushel of May soybeans, theoretically. And as you can see, that blue line, even though there's a little bit of wiggle room in it, it's just basically steadily higher as we go by month. So it's been a very strong time. And of course, the one outside factor that's helped keep the crush incentive very strong this year is having the drought in Argentina. So there's going to be less competition for those soy products because of that. The other thing I forgot to mention, I won't be surprised if we don't see Argentina import some soybeans from Brazil, keep their crush plants going this year because they don't have a lot of soybeans available. As far as the speculative positions for soybeans, similar to corn, we see a pretty wide distance here, but the difference is this market has not broken down. So the non-commercial long positions in the market are not under stress to liquidate the way they are in corn. Right now, our most recent reading on this, specs are net long, just over 174,000 contracts in soybeans. As you can see from the lower part, it's quite a wide disparity. There's not a lot of interest on the short side of the market. So we do have a fairly bullish contingent here of specs in there that one day could be a risk of selling, but the way things are going right now, they're just not feeling the stress. All right, we've gotten through two of the crops. Let's take a look at what USDA said for wheat in today's report. And the U.S. balance sheet is very easy to explain. It's the exact same balance sheet we saw last month. The exports are unchanged, 775 million bushels. Wheat export pace is actually staying close to the estimated pace, so there was no reason really to make any change there. The ending stocks estimate stayed the same, 568 million bushels. That works out to almost 30% of annual use. The average farm price for the soybean estimated at $9 a bushel. On looking at the different classes, again, not much to report here. All the ending stocks estimates for the various classes of wheat all stayed the same. Hard red winter crop still at 273 million bushels, hard red spring at 120, and the Chicago soft red winter crop 102. So all those ending stocks estimates stayed the same today. The world ending stocks is going to take a little bit of explaining here today. It's a little more complicated than usual, but if we start in the upper right corner, the estimate of world ending wheat stocks was reduced slightly from 269.3 down to 267.2 million metric tons. When we look at the metric that excludes China, the ending wheat stocks were actually increased a bit from 124.75 to 127.62 million metric tons. Now there is, if you notice, I put a red box around the beginning stocks in the upper left corner because if you notice there, we see a roughly 5 million metric ton reduction in the beginning stocks. And when you see that big of a change, it points to a revision in a previous year. And it turns out that USDA went back to the previous year, the 21 to 22 season, and they increased China's corn demand by 4 million metric tons. And so that reduced the ending stocks number for that season, which is the beginning stocks number for this season. So basically they said China consumed 4 million metric tons more of wheat than we recognized, and that reduced, and that had an impact of reducing our wheat stocks in the current balance sheet. So if that was a bullish factor, it reduced wheat stocks. Why did the ending wheat stocks go up? Well, there were some increases in the production estimates, and just a couple are shown here. There was a slight increase in Argentina's wheat crop. Now, that was a surprise. It's a small amount, but as you know, Argentina got hit very hard by drought this year. But they gave Argentina a slight increase. And then they increased Australia's wheat estimate by 1 million metric tons up to 39 million metric tons. And earlier this week, Australia's government came out and increased their estimate up to 39.2. So that was no surprise. Additionally, what I don't show, but what is shown lower on the table, if we had the whole page presented here, was that the production estimate was also increased. Or is this off? Oh, excuse me 1 second. It was India and Kazakhstan. Yes, it is shown. It is shown on the WASDE page. So there was, in India, there was a 1 million metric ton increase in India's wheat production estimate. And for Kazakhstan, there was a 2.4 million metric ton increase. So between those two countries and Australia, we get roughly a 4.4 million metric ton increase. And that's where the increase factor came in on the ending stocks part of the end of the wheat estimate. So sorry if that's a little confusing, but at the end of the day, the ending stocks wheat estimate went slightly lower from 269 down to 267, while the ending stocks outside of China, which I consider the more important metric, actually went up a few million metric tons. Maybe that's the bottom line place to leave it for that. World wheat supplies, and this is the history of world wheat ending stocks excluding China. It's still at the lower end of where it has been, but even though the number went up this time around, we're now near 4.7 billion bushels. It's the lowest in 10 years. At one time, USDA was estimating the lowest in 15 years, but now it's just the lowest in 10 years. So overall, it's still a fairly tighter supply estimate for world wheat supplies. And is also still confusing why world wheat prices are this low. But as I mentioned, I've created a new model here of pricing, putting prices in relation to their cost of production according to their supply situations. And in the case of wheat, I have to mention that, first of all, the correlation on this model is quite low. The R-squared value of 0.28 is a pretty low correlation. So it's not as strong or as well-defined as it is for corn and soybeans. But I will say in this model, the 30% U.S. ending stocks to use ratio suggests that a correct price for cash hard red winter wheat would be $7.72 a bushel, which is 15% below the all wheat cost estimate that comes from USDA. Now, number one, that surprised me that historically it would suggest that low of a price. But I think even in this case, it's important to point out, given the environment we're in, that this is an extremely low price when you consider that the market obviously is not pricing in any war premium or uncertainty factor from the Russia-Ukraine situation, and that we have several estimates of smaller new crop situations ahead, but there's no premium in the market granted for that yet either. So it continues to be confounding to me how it is that wheat prices can trade this low. And of course, I would suggest that time is on the side of those holding out for a better price. But obviously, I've been quite wrong the past several months here, watching prices tick lower. The basis for HRW wheat this year is, we're in a funny time of year, number one. If you can see on the history here, we've had some big swings in the 5-year range this time of year. In the current moment, the cash basis is 31 cents below the May contract. We're slightly above the 5-year average. I'm going to call this near average, basically, for the HRW wheat basis right now. But overall, obviously, we're, yes, sorry about that. I was just distracted. I saw Kent's question come in, and I'll get to that later. But we're at a near average basis here for HRW wheat, nothing too much out of the ordinary. Kansas City wheat, the spec positions. Here we have the chart of Kansas City wheat. Obviously, we've been trading between $8 and $10 over the past year. And here's a couple things I wanted to point out. That number one, even in Kansas City, which is not where the focus of the short positions are. Most of the short positions are being held in Chicago. But even in Kansas City, if you look at the red line, that's the non-commercials that are bearish in the Kansas City wheat market and have pushed prices now down below $8 a bushel. We're looking at the largest non-commercial short position that we've seen in over 2 years. And typically, when you look in the past, when those non-commercial short positions get elevated, as this one is, they tend to lose that battle. And they tend to lose that battle, especially when commercials step in on the long side of the market, as they have recently. So that is the main thing that suggests to me that even the commercials recognize value at these cheap wheat price levels, and something's got to change the dynamic. What's going to change that, I don't know yet. But I thought it was interesting that if we looked at the last time Kansas City wheat was near $8, there was a smaller short contingency in the market. And then we had a rally from 8 to 10, and the non-commercial long positions didn't really change. That is to say, people didn't really jump in and buy this market, but most of that rally came from the short covering that occurred as prices went up just from 8 to 10. Well, that was from a smaller position in shorts than we're seeing now. Now, take the Kansas City position and magnify it times 10 in Chicago wheat, where the funds alone, not all of non-commercials, but just the funds, are net short the equivalent of 360 million bushels of soft red wheat in Chicago. To me, that's still a potentially bullish arrangement here, because the U.S. did not even produce 360 million bushels of soft red winter wheat. For the funds to be having that large of an obligation here at this low of prices just seems crazy and very dangerous to me. So obviously, I can't guarantee how this will shake out, but I can just tell you from past history, typically the specs lose in these situations. And it just makes me wonder what's it going to take, what's going to trigger the market to start to scare the specs out of the market. That's what's hard to tell. In conclusion, today's report, I would say, was slightly bearish for corn. The 1.34 billion bushel ending stock estimate was a little more than expected. It was not a shock to the market. Everybody knew that the exports aren't doing well. The 210 million bushels of ending stocks for soybeans was slightly bullish and continues to put us down in a very tight situation as far as supplies go this summer. Those soybean stocks continue to be the lowest in 7 years. And on wheat, I would say today's report overall was neutral for wheat. The ending wheat stocks to use ratio remains at its lowest level in 9 years. The actual ending stocks themselves are the lowest in 15 years. So it's still a tight supply situation that's not being properly priced by the market in my book. Before I ask Andy for our questions for the day, I just wanted to point out that an even more important report in my mind is coming up on March 31st, and that's the quarterly grain stocks report. And then along with that is the prospective plantings, which, as you know, is the first survey of the year asking farmers what they're going to plant. So we will be back for that. So, Andy, I think that's all I've got today. So go ahead and give us the questions.
Yeah, good stuff today. Thanks, Todd. So we really only have one question, which is for those holding wheat, how much time do they have to wait until it's on our side?
Yeah, I wish I knew the magic answer to that, and I just don't have the magic 8 ball today. Very, very tough to say. As I tried to explain just now in the commentary, it's going to take something to trigger a little scare. You know, usually it doesn't take a lot to scare traders in a market, but when you're holding short 360 million bushels at prices that are basically either near or below their production cost, I would be a lot more nervous being short than I would long. And I know for those that own wheat and want to sell last year's crop, it's been a long wait for a better price. But it's just going to come down to the individual producer and how much they can take. I wish I could give you something better, but that's the best I can do in this situation.
All right. Well, thanks for that. That is actually the only question we had. So we will go ahead and Thank everyone for joining today. And just a quick reminder that the event has been recorded, and we'll have a rebroadcast link up on dtn.com within the next 48 hours. And if you do have any additional questions, Todd, I think your last slide might have your contact information.
Oh, yes. Thanks, Andy.
Yep. So there we go. If anybody does want to reach out to Todd, there's his information, and we'll leave that on the screen for a few seconds. Otherwise, that concludes our event for the day. Thanks for joining, and hope everyone has a good day. Thanks.
Thanks all.